Chinese banks are running out of money. Banks are in a state of crisis. The current situation in China's banking sector is so bad that over 2,000 bank branches have already closed down. Today, we're going to talk about the problems that China's banking industry is going through right now. This is because of issues with the banks in Silicon Valley and also because COVID hurt their economy. Let's start with the bank closures. The collapse of Baosheng Bank has really hurt all the banks in the Henan province's countryside. This made people who had accounts there very worried because their money got stuck and they got scared. Now, the former vice president of China, Zhu Dai, shared his insights recently and gave a breakdown of similar issues happening these days. He's saying that these problems are more on the local side of things and that they're not huge problems that could cause any harm to the entire economy. But as you'll find out later in this video, that actually isn't the case. He claims that things have been looking up and it's a small risk, especially after the regulatory changes. He's also pointing fingers at problems in U.S. banks caused by people moving their money to get more interest. This messed up foreign money like the Chinese yuan. But, of course, it's not all America's fault. In 2022, the country's economy chugged along at a modest 3% growth rate, which might sound all right, but compared to China's usual growth, it's nothing. What put the brakes on was a real estate slowdown and all those COVID restrictions. China's been trying to bring things up by attracting foreign investments. After all, people in China don't exactly love spending money or investing as much as we do in the West. But Zhu has a plan to use new manufacturing methods and a strong effort to reduce pollution. This could help improve the situation. In terms of bank closures, over 2,600 branches have been closed since 2021. The big banks that belong to the government and some private companies are moving to do banking on the internet and offer their services that way. The good news is that some other banks didn't like this new thing happening. In 2021, more than 2,300 new branches opened. Most of them were from smaller banks like city and rural banks. They're expanding their physical presence to tap into markets that haven't been fully explored yet. It's fair to say China's banking sector is dealing with many problems. Starting with the concern over non-performing loans. These are the loans that borrowers are having a hard time paying back and their profits are also starting to shrink. Not exactly the kind of situation you'd want if you're a bank, right? A big issue is with something called local government financing vehicles. These are like the money organizers for local projects like roads and buildings. This has made investors a little worried. And if that wasn't enough, there's the property sector situation. It's been having trouble dragging these bank stocks down. Goldman Sachs has also given their analysis and given the major banks a sell rating, which really plummeted the stock market. But not everyone's on board with Goldman's analysis. Some people call it a pessimistic assumption and say there's been a bit of a misunderstanding. They're trying to put a positive spin on things and reassure people that maybe it's not all as bad as it seems. Sure, this reassurance gave a bit of a breather to banks like the Industrial and Commercial Bank of China, which had seen its stock take a 13% hit in 2 months. But the mood in the market is still kind of gloomy. China has been announcing plans to boost the economy, then stopping and starting again. People aren't buying things as much, and there's worry that banks might need to step in to help. This is making investors worried and unhappy. Could there be a silver lining? Well, some people believe that a big problem probably won't happen because of these local government money plans. But that doesn't mean the banks are out of the woods. They still have to deal with the headache of more non-performing loans and shrinking profits. Imagine local government's revenues taking a hit. That could mean more loans going south, and the banks will be left to pick up the pieces. Gary Ng, who's a smart money expert at a bank in Hong Kong, made the current situation easier to understand. He said if local governments can't pay up, the banks will have to bear the brunt. So, while the sky might not be falling just yet, these Chinese banks aren't exactly having a walk in the park. They're facing some serious headwinds, and investors are keeping a close eye on how things play out. To add to the confusion, the Chinese economy surprised everyone by growing faster than anyone thought it would in the first part of the year. That's a pretty solid rebound from 3 years of dealing with the pandemic's effects. But the recovery hasn't exactly been smooth. There have been some hiccups like exports not quite hitting the mark and Chinese citizens being a bit careful about where they spend money. At the beginning of the year, China saw some pretty strong action about new bank lending. People were getting loans left and right. But that lending party started to cool down as we moved along. So financial institutions decided to do something about it and cut interest rates in June. That move brought down the benchmark one-year loan prime rate to 3.55%. analysts are still giving warnings. They've been saying that things might not all be sunshine and rainbows. Earlier this year, they said that the increase in credit mainly happened because they gave out loans for big building projects. Imagine some big banks offering interest rates below 2% to state-owned companies. That's lower than the rates they give to depositors, and it's putting a bit of a squeeze on the bank's profits. Speaking of profits, over the last 10 years, Chinese banks have seen their net interest margin shrink by about 1 percentage point. In the first quarter of 2023, this margin was hanging around 1.7%, according to data from Refinitiv. And to make things worse, the ratio of stock prices to earnings is at 4, which is only half of what it was back in 2018. But Goldman Sachs dropped another bomb by downgrading the Agricultural Bank of China from neutral to sell. They decided to change their minds about the Industrial and Commercial Bank of China, or ICBC, and the Industrial Bank. Before they said buy, but now they're saying sell. You might think that low valuations could mean these stocks are about to climb, but Goldman says there might be more dips in the road ahead. The reason? They're pointing fingers at local government debt, saying it could start to nibble away at profit margins. Lately, the people at Morgan Stanley have noticed the China banks have been dealing with a continuous process of handling risks. That's a fancy way of saying that they've been dealing with a bunch of financial challenges. They mentioned that about 25% of the money tied up in industrial and trade finance had turned into non-performing loans between 2016 and 2020. Goldman Sachs checked the numbers and figured out that the 6 largest banks in China have more than $4.2 trillion in debt from local governments. And believe it or not, they have the room to handle even more of this debt. Worst of all, Goldman thinks the banks will still be up for taking on more, even if the interest rates on this debt drop. Why? Well, this type of debt has some nice benefits. It gets special help with taxes, and it's pretty safe for saving money in case of emergencies. Also, these things could be used to get money from the central bank if needed. Goldman Sachs also tried to guess what might happen. They said that tax and money-saving benefits could help stop banks from losing a lot of money on their investments, which is called return on equity. It's like a safety net. According to their predictions, they're seeing a 12.5% ROE for 2023 and a bit of a dip to 11.9% by 2025. These numbers don't sound that impressive, but if you compare them to the banks in America and Europe, they're actually not that bad, at least when compared to most banks. So let's talk more about China's economy. China's small and medium-sized companies, or SMEs, have been running into their fair share of problems. Sure, some people are saying that China is doing better after COVID because of some big changes in their economy, but small businesses are still having problems. The thing is, China's aiming for a 5% growth target, and those SMEs are supposed to play a major role in hitting that target. After all, they're the backbone of the manufacturing and industrial sectors, making up over 60% of the country's GDP. They're also responsible for a big chunk of the stuff China exports to the rest of the world, so you can see why they're kind of a big deal. Good news! In January of this year, Beijing began discussing ideas to support small businesses. President Xi encouraged these businesses to keep making and selling their products. It sounds good on paper, but despite all the talk and promises of support, these SMEs are still stuck in a rut. If we check how well they did in February, we can see it's the worst it's been. Things like making stuff, getting new orders, spending money, keeping things in stock, and making profits are all having a tough time. And even though people thought the economy would get better, it really hasn't helped them. Before COVID came around, these small businesses were already used to ups and downs in the industries they made stuff in. But then the pandemic made things worse when everything in the world came to a halt. In fact, a survey revealed that over 85% of these businesses didn't have enough cash to survive a 3-month shutdown. So, as expected, loan repayments became a major headache. These companies are having such a hard time that they're forced to take on more loans than they did last year to keep their production lines running. If things were looking bad in 2021, they're definitely not getting any better anytime soon. Do you think more Chinese banks will be closed in the future? Let us know in the comments below. And thanks for watching. We'll see you again soon. Make sure you watch the next video.